Well, hey, everybody, this is Linda with the Connecticut Real Estate Investors Association, and I am actually very excited about this presentation. We've never done this before. Ted Lanzaro has been a sponsor of CPA for a very long time. He's done an excellent job supporting both our members and our coaching students. He's a real estate investor himself, and he's worked with lots of different portfolios from small to large to help people save as much money on their taxes as possible. And, one of the questions that comes up is, which of the many different ways of making money in real estate should I do first? So I was talking to Ted, and I thought, every person is different. Everybody's financial situation is different. Everybody's financial needs are different. So I thought it'd be a really cool idea to have a conversation about, from a tax perspective, which strategy is best for different types of people based on where you are. So I'm hoping that you'll sit back, take some notes. Please mute out your phones, by the way, if you can, so we can get a clean recording of this. There is a chat box here where you can type in messages and questions, and so there will definitely be time for Q&A with people. But Ted, I'm going to turn this over to you. So go have fun.
All right, great. Thank you, Linda. I appreciate it. What's kind of interesting about this whole presentation is even though I'm a CPA, you had mentioned that I'm a real estate investor, I've actually done all three. So I've wholesaled properties, I have extensive background in rehabbing properties, and I've been a landlord for quite a bit of time. So it's kind of cool to be able to look at it not only from a tax perspective, but to sort of add not only my clients' stories, but also my own personal kind of stories on what we can use and what we can do and that sort of thing. So I'm essentially a tax consultant to the real estate industry. That's what I do. I'm also, like I said, an experienced real estate investor and landlord. And I just finished a book which is going to be out soon, Tax Smart for Landlords. And
cool.
I'll let everybody know when it's out. It's been a process, that's for sure. But
whoops, are you there? Hold on, I'm sorry. I think I muted somebody. Ted, are you still there?
Yeah, I'm still here, yes.
Okay, sorry. I think I muted you out. Apologize. Go ahead. Sorry.
Okay. So
yeah, we're definitely looking forward to your book. We're with bated breath here, so we're very excited to see that for sure.
Yeah, what's funny about that is once you write the book, then you have to put the infrastructure around it before you can actually release it, and so that's what we're working on now. It's not as I wish it was easier because it's not. But anyway, let's kind of start with some sort of all-purpose kind of tips. So no matter what you're doing, whether you're a wholesaler, a rehabber, or a landlord, or you might be a combination of all three, okay, because I certainly have clients that do all three, here are some tax strategies. Here's some basic things that everybody has to sort of think about. No matter what you're doing, okay, you have a unique circumstance. Everybody does, okay? So what you were just talking about, Linda, where people have different jobs, whether they're full-time in real estate or whether they're working at their career and then doing this part-time, how much money they're making at their jobs, that's a consideration. Whether when you get started, what are your goals? Is your goal to try to create some passive income? Are you trying to start a business? Are you trying to replace your business income? A lot of people get into wholesaling and rehabbing, for example, because they want to get out of their job.
Right.
A lot of people start landlording because they want to invest their money they're making in their business. So it's kind of, there's two different kind of, thought processes there. There's different tax strategies for all those different people. And that's why it's not a kind of one-size-fits-all kind of deal. What we're going to talk about tonight is something that might be great for one person on the call and might be awful for another person on the call. And we just have to, you just have to know that everything we talk about has to be tailored to your situation, okay?
Yep.
The foundation of everything we're going to talk about starts with good record keeping. And anybody who's on the call who has seen one of my presentations, it always starts with keep good records, and I'm sure people are getting tired of hearing this, but it's such an important point because, as I said last night, you can't build a house on quicksand. So you need the good record keeping is the foundation to use any of the tax strategies we're going to talk about tonight, whether you're a wholesaler, a rehabber, or a landlord. There's going to be things you have to keep track of in order to take maximum advantage of the tax code. So just keeping good records is just it's practical, if anything else, and it allows you to really make sure that you're not missing anything, you're taking maximum advantage of the code. The other all-purpose tip that I'll tell you, and we talked a little bit about this last night also, is whether you're a wholesaler, a rehabber, or a landlord, you probably have people that are providing services to you. Definitely if you're a rehabber or a landlord, but you may have, as a wholesaler, you may have people who are partnering on the deal with you, or they might have provided the lead, the bird dog fee that you might pay out to somebody, something like that. Those people need to get 1099s. And in order for you to deduct the expenses, you need to be getting the information that's necessary to provide them with the 1099, which is called a Form W-9. That's available on the IRS's website, or you can call me and I'll send you a copy. But everybody needs to be filing these at the end of the year because the IRS is making a major push for compliance in this area, and if you they will audit you in just this area, and if you're not, if you haven't done the proper compliance work filing the 1099s, you could lose the deduction for those things that you paid, but you did not file a 1099 on. So it's a kind of an interesting point. Let's talk a little bit. Let's start. So I guess we'll start with wholesaling. Okay.
Okay.
So wholesaling, I guess everybody on the call knows what wholesaling is, but wholesaling is basically when you put together a deal and then you never actually buy the property, you just sort of flip it over to somebody else and you collect a fee. So wholesaling, the income that you get from wholesaling is basically fee income. Okay, it's ordinary income from the standpoint that there's no capital gains treatment. It's all kind of just a fee that you got for putting together the deal. Okay, the people that I have that are doing a lot of wholesaling, their expenses that they have against their wholesaling income is primarily related to finding the properties, marketing and selling the properties off. So they're basically engaged in the business of list building on both sides. They're trying to build a list of leads coming in, people who want to sell their houses, and they're building a list of people who want properties that they can then wholesale them off to. So in a lot of cases, it's really it's a real estate investment business, but it's a real estate investment business that really has a big marketing component to it. So you're going to spend a lot of your money on the marketing in and out and the services that you need to do that. Okay, it's a business, so it's considered a business, and as a business, it's considered ordinary income, and that ordinary income is subject to self-employment tax. Okay, so a lot of the wholesalers that I do business with, they have an LLC, and they're reporting their wholesaling income and expenses either via a Schedule C on their Form 1040, their personal tax return, which is the form that you use for businesses, or if they have a partner, maybe it's a partnership, or it might be a corporation, might be an S corporation that they're doing business in, and they're doing all the work through that corporation. In any case, what happens is if you have net income after you pay your expenses, that net income is going to be subject to self-employment tax, okay? But the good news is that if you run a loss, and a lot of people run losses at least for the first year or two because it takes a little while to kind of get those lists built and get that momentum where you're doing enough deals that you're actually making money, you can deduct the losses on that business against your other earned income. Okay, so that if you're doing this part time as a wholesaler and you're working at your job or you're working at your business, and then you have this other wholesaling business and you lose money in the first year or two, those losses get subtracted from the income that you earn in the year that they occurred. So that's the good news. Unlike rental income, for example, which may be limited, wholesaling losses are never limited. You can use them to offset your ordinary income. So let's assume now that you're making money wholesaling. Okay, that's where you obviously want to be. So then here are the tax strategies. Okay, so there's two essential ways that you can be taxed when you have a business. Okay, the first one is you're either like a sole proprietor, you're either working as your own name, or you have a company, an LLC, and that LLC, the net income from that LLC, all that net income is going to be subject to what's called, not only is it going to be subject to federal and state income tax, but it's also going to be subject to what's called self-employment tax. And self-employment tax is basically just like the Social Security and Medicare that gets taken out of people's paychecks, okay, when they're employed. What a lot of people don't realize is when that money is taken out of their paycheck, their employer matches that money before they send it to the government, okay? So now when you're an LLC, when you're in your own business, the wholesale business, right, you're both your employer and your employee. So you get to pay this self-employment tax. Now, typically what happens is once net income goes over $50,000, it becomes tax beneficial. So the first strategy would be tax beneficial to use an S corporation instead of an LLC. And the reason that is because an S corporation allows you to cut the self-employment tax in half. Because you can take 50% of your, so let's say your profit is $50,000. You can take $25,000 of the profit as salary, and then $25,000 of it as a distribution that's not subject to self-employment tax. Whereas in the LLC, the entire $50,000 of net income is subject to self-employment tax. So you're saving 15% of 75, or it's 15% of $50,000, $7,500 divided by 2. So you're saving $3,750 in taxes by using an S corp with $50,000 of income instead of an LLC. Now, that may be the right move for somebody. Might be an awful move for somebody else. Okay, so that's why it has to be, when we talk about tailoring it specifically, that's why we have to look at each person's specific situation. Okay. Okay. So now, and part of that situation is the next point, which is retirement plans. Okay. If all I'm doing is wholesaling, right? And let's say I have this $50,000 worth of net income I've made this year wholesaling properties. Okay. Well, I might not need that $50,000. Like I was meeting with some ladies the other day, and they're basically like, well, you know, our husbands work. We're just doing this sort of to have a little fun and make a little money. We don't really need the money, you know. We're just, you know, right? So in their case, they might say, well, you know what? Let's fund a retirement plan. Let's max out a retirement plan. So one of the benefits of having an LLC versus an S corporation is you can put more money into a LLC retirement plan than you can if you're an S corporation because of the different limits that exist. So in a S corporation, you would have a 401k. The limit for that 401k is like $17,500. total contribution. Whereas in a LLC, you would be able to put away 20% of your net. That could be higher than that $17,000. You could actually, the more money you make, the higher it goes. I think the limit at this point is you can put away over $50,000 into a SEP, a self-employed pension. So, but it's income based. But the more income you have, the more you can put away. So that's why I say, specific to you, what did you make? I might have a different strategy for somebody who's got wholesale income of $150,000 versus $50,000. Okay, different strategies, different dollar amounts. Right. Mm-hmm. The other thing that you have to do, and we were talking about good record keeping before, is you want to maximize your deductions. You want to basically look at everything you do and say, how can I deduct that? How can I make that deductible? And in last night's conversation, we were talking about things that landlords typically miss. Everybody knows that you can deduct the mortgage interest and the real estate taxes and the insurance. But typically, landlords are going to miss the fact that they can deduct some of their cell phone, or they can take the home office expense. These are all things that apply to wholesaling also. Okay, so you want to make sure your everything that you're using in your business, your internet, because if you're wholesaling properties, you're on the internet, you're talking on the phone. You're driving out to properties to look at them. You may have people that are kind of helping you along the way. Maybe you have an inspector or a contractor that's helping you figure out what the repairs are, so that you can say, hey, this house, I'm looking to wholesale this house, and it's going to cost, $20,000 to repair. You got to know what your repair costs are in order to wholesale properties. Because the rehabbers that are going to buy those properties from you are going to want to know that. So all of these different expenses, we have to find a way to get them, gather them together, organize them, and make sure they all get deducted when it's time to do the tax return. The other thing is a lot of people do this business from home, so you need to make sure that you're tracking all of your home expenses. So everybody knows that you can deduct the mortgage interest and real estate taxes on your house, but for the home office deduction, you can also deduct your homeowner's insurance, all your utilities. Now, we're talking about a portion of that, but your utilities, your maintenance. Now, the way all of that works is if I've got a room in my house that's 200 square feet and it's used solely for my wholesaling business, and I've got a 2,000 square foot house, so my 200 square foot office is 10% of my house. Well, then I can deduct against my income, my wholesaling income, I can deduct 10% of my home expenses against that. That's something a lot of people miss. And unfortunately, there's sort of a myth that has circulated amongst tax preparers that you shouldn't do that because you're going to have to depreciate your house. Well, it's true that you have to depreciate your house, but only that portion which you're actually depreciating, just the office portion, and the depreciation is so minimal that it's silly not to take advantage of the home office deduction. Now, when you're wholesaling, the other thing that, and I see a lot of investors make this mistake, is when they start making money, they don't put enough money away to make their estimated tax payments. So they just, I made $5,000. Let's go spend it. Well, there's, if you have net income, you have tax. And what happens is, think about it from this standpoint. Every net dollar you make, net income after expenses, you probably owe the government 35% of, because you've got 15% self-employment tax, minimum 15% federal income tax, and minimum 5% state income tax in the state of Connecticut. If there's callers in, from New York or Massachusetts, your rates are a little bit different, but they're still 5%, 6%, 7%, whatever they are. So you have to look at that and say, hey, 35 to 40 cents of every net dollar I make is not really mine. And I need to be putting that money aside so that at the end of a quarter, I can make my quarterly estimated payment accurately. And typically what I have is I have people that will come to me, like let's say they come to me in April and they say, what is my estimated payment? And I'll say, okay, let's look at what you did. How much money did you make from January to March? And then we calculate how much money they made, and based on how much money they made, we calculate the tax that would be due on that money, and then we have them pay that tax into the government, And that's how you sort of stay kind of on the straight and narrow, because if you don't do that and you end up making $50,000 at the end of the year and you spent it all, you probably owe $15,000, in taxes or more, and then, didn't know that, now how do I get that money? Well, then you end up getting behind, and you end up getting in a payment plan or something that's not bad, something that could put your wholesaling business out of business, So overall, wholesaling is a good business, and it's a business that you can make money at, but you always have to remember that the money that you're making is business income like any other business, and it's subject to all the taxes that kind of go with that business.
So it's good if somebody's, so if you, the advantage to wholesaling is that, yes, you have marketing fees, but you're not tying up your money in rehabbing a property, like a rehabber, and I'm sure you're going to get into that, but it's definitely another job or it's another source of income. So if you're somebody and you're trying to get out of your job as quickly as possible, there's a lot of skills involved. You have to, that's the thing, one thing, this is an aside from taxes, but one thing that people kind of skip over when they're talking about wholesaling is that you have to be able to know what the property can sell for. You need to know, be able to estimate pretty closely anyway how much it's going to cost to rehab, so that you can negotiate the right price. And then you definitely need to have a list of people that want to buy your property as quickly as possible. So you have a lot of skills involved, but you're more tying up more of your time than your money. But as Ted saw, you're going to treat this income just like any other job or any other self-employed business. If you're a contractor or an attorney or even a CPA, whatever
right.
business is, you've got the same kind of taxes, correct?
Right, exactly. And it's a great business for people who want to kind of get started, who don't want to tie up a lot of money, or simply maybe don't have a lot of money to tie up, but they want to get started doing some stuff. And also it's a great way to learn the kind of skills that you need to be a rehabber. So like you were saying,
right.
You need to learn how to estimate costs of what things cost in houses. Well, you're going to definitely need that skill as a rehabber. And and we'll talk about this in a little bit, when you're a rehabber, you are maybe possibly tying up some of your own money. The ideal situation would be not to use, other people's money, private lenders and such to do your rehabs. But typically speaking, a lot of my clients will put some of their own money in, and in that scenario, sometimes they'll have all their money into deals, but they're still getting deal flow. They're still getting, potential buys in. So now they turn from rehabbers into wholesalers because they've got all their money tied up. So now they're going to help some people, some other people get into some properties because they don't have enough money to do all the properties that they can bring in from their marketing. Make sense?
Right, exactly. Yep, sounds good.
Yeah, so it kind of works both ways. And I tell you, I think one of my rehabber clients, and I'm talking to a few of them right now because we're finishing up taxes for 2014. The biggest thing that I'm hearing from people is, man, I wish I knew more wholesalers. I wish I knew people who had lines on properties.
Yes. Yep, I hear that all the time. So cool. All right, good.
Yeah.
All right. So, by the way, if you have any questions on this or anything else that Ted's discussing, there's a little chat box there, but you can also send me an email to membership@ctrea.com, and we'll get you taken care of there.
All right, great. Yeah, that sounds good.
All right, so what's next?
So let's talk a little bit about rehabbing. Okay. So rehabbing is, you're basically going to buy the property, you're going to fix it up, and you're going to sell it. So it's a business where you are selling properties in the hopes that when all is said and done, you're actually going to have a net gain on the sale of the property. You're going to get more money back out than you put in, you know. But the income is based on actually selling the property. So you don't get paid until you've actually sold the property. So what happens, and the reason that's interesting is because all of the fixing up and holding expenses related to that property are not deductible until you sell the property. So you can't like buy a house, spend a whole bunch of money repairing it, and deduct them all as repairs at the end of the year. It all becomes cost basis of the house. It's like you have to capitalize or make part of the cost basis of the property every dollar that you put in for fixing and holding the property. So all the repairs, the interest, the taxes, the insurance, the utilities, all of those things are part of the cost basis of the property until you actually sell it. And then you apply all that money that you spent against the money that you sold the house for, and you're hoping that and most of the time it works out, and you're hoping that there's a pot of money left at the end. For the most part, rehabbers are engaged in an ordinary income business just like the wholesalers are, okay? And that applies specifically, especially to people who are actually doing it as for a living, okay? So if the only thing you do is buy, fix, and sell houses, okay, for a living, then it's a trade or business that's going to get reported like a trade or business when it's time to do your taxes, okay? Some people say, well, can I take my sales as capital gains? Well, in certain circumstances you can, okay? Let's say, for example, that I'm only rehabbing because I can pay all my bills from my business. I have another business, for example, and I can pay all my bills. I'm not going to use any of the money that I get from rehabbing a property for purposes of living. But the only reason I'm rehabbing properties is because I'm going to use that money to fund down payments to buy rental properties. Okay? So then I can, especially if I have a business where I'm paying all the self-employment tax on, through my business on my business income, now my rehab income could be considered capital gains in certain circumstances. And again, it's very individually specific. Okay? So we have to look at your specific circumstance. But let's kind of get back to, our ladies that I was talking about who came in and they really didn't need the money. They were just kind of doing this for fun. They're going to be rehabbing. If they don't use the money to live on and they only use it to sort of build a portfolio of rentals, then I could make a very good case that they should be taxed at capital gains rates instead of ordinary income rates because they're not really in the business of making money by rehabbing. They're funding their investments by rehabbing. Does that make sense?
Yes. Yes.
Yeah. Okay. So sometimes you can get capital gains treatment. Otherwise, it's going to be ordinary income, and it's going to apply the same things that apply to wholesaling. It's going to be the self-employment tax and that sort of thing. So let's look at some of the strategies for this. And they're basically, in a lot of cases, they're basically the same strategies that we were talking about with wholesaling. So I won't literally reiterate everything I said, but let me just remind you that and when you're rehabbing, there's a potential to make more monies because, let's say you're making $5,000 on a wholesale deal. On a rehab deal, most of my people are making, $25,000, $30,000 or more per deal. So there's a situation where a lot of the clients that I'm dealing with are making 100, 150, 200. Sometimes they hit a home run, they make 100 on one deal. That's
right.
not unheard of. So you can have rehabbing income that is $100, $150, $200,000 a year or more. So that's where
I have a question, by the way. Sorry, the S corporation. I've really heard people talk about that for quite a while. Are there some newer changes or something in the tax code that makes? Is this an S corporation or subchapter S, or is that the same thing?
Yeah, it's a subchapter S corporation. The only reason you want to use that, by the way, is because it allows you to avoid the self-employment tax.
Oh, I see. Okay.
That's the really big benefit of it. Okay. It has some downsides, and you have to look at the good and the bad. Okay. Like, for example, one of the bad sides is you are going to basically minimize how much you can put into a retirement. You're gonna say, okay, I'm willing to accept that limitation because I'm not going to really put that much money into retirement anyway. It's funny, unless the people are putting the money into a self-directed retirement plan, most of my rehabber clients don't want to put the money away. They don't want to take the money. See, what happens when you really are a good rehabber and really doing it as a business and you've got a lot of properties to work on, you've always got money sort of in a spin, right?
Right.
You're putting money you're taking money, you sell a house, and you're immediately taking it and putting it into the next house, the next deal, that sort of thing. And so in order to fund a retirement plan, you'd have to take the money out. You're like reducing the amount of capital. People hate doing that, so they don't want to reduce the amount of money they have available to do more rehabs, so they don't want to fund the retirement plan, even when it's tax advantageous. Unless they can fund it self-directed, so they can roll it back into something that they can use. So it's kind of interesting, but yeah, that's one of the downsides is you're kind of caught in the limitation of what you can put into a 401k. The other thing is if you're using an S corporation to run your rehab business, you're basically saying I'm a dealer.
Say that one more time. So what you just said.
When you're using an S corporation to run your rehabbing business, the IRS is not going to call you a dealer, but you're basically saying that you're a dealer. You don't come right out and say it, but you're treating yourself as if you were a dealer. Okay, so there's some downside to that. There's some downside to that. Well, there's certain types of limitations on doing that, where it might affect if you own rental properties. There's some strategies that you're going to have to use to basically offset some of the negative things. Like, for example, if you're considered a dealer, you don't get installment sale treatment if you go and sell a property and hold a mortgage. If you hold the mortgage, you have to pay tax on the whole dollar amount, even though you haven't received the money. Whereas if you were
that would be with us. So that would be like if you want to be able to hold the mortgage to sell your property on you write the mortgage in the note and you're holding that, so that could affect you. So, and again, the only reason, we don't want to complicate, we don't want to get you all confused. I would write down key terms and key notes as you're listening to this, and it's being recorded, so so that you can listen to it again. But the point is to be able to sit down with your accountant or somebody who's as smart as Ted is and just lay out everything and what your plans are. And my other caveat I want to put in here is do not let any of this stop you from going out and buying a piece of real estate, because sometimes, especially when you're brand new, you're so worried about everything. You try to set up everything for asset protection and taxes and everything else, and you forget to go buy a piece of real estate. So you want to do everything in conjunction. And then the other piece of this is we have a really good he's a sponsor of us, but he's really good and very smart guy, and Kevin Collins with Advanta IRA. They are really good at all the self-directed stuff that Ted was just referring to. So.
Yeah, and he's a really sharp guy. I like him very much. We talk every so often, have lunch every so often, and he's a very good resource. He was a good resource for me while I was doing the book, and so I think that's a good 2 chapters of the book are dedicated to self-directed IRAs. So that's a great strategy. And once you get enough money into that self-directed IRA, you can actually start doing rehab deals in the IRA. And then if you make $25,000 or $30,000 on the deal, yes, you have to put the money back in the IRA. But I've got a lot of clients that are doing deals, that have a few $100,000 in their IRA because maybe they came out of corporate. They had jobs where they had big corporate benefits like that, and now they take their money that they've been saving for 20 years or whatever, and they roll it into a self-directed IRA and they start doing rehabs, right? Well, they're not able to use the money that they're making, but the money keeps growing inside their retirement account, and they never pay a dollar in taxes on it until they start drawing that money out when they get older. So it's a great way if you have a pocket full of money, this like a bucket, that you can use like a retirement account. That's a great way to do, say, 1 rehab, or 2 rehabs, or as many as you can do, and just keep building up that fund. You can make a considerable amount of money doing that. It's interesting what you just said about people kind of get caught up in the asset protection and the tax work. Where all of this, and I think this is a really key point for everybody to remember, all of this starts with making money. If you're not making money, no, seriously.
Yep.
I mean,
right.
You gotta, for all of this to even be worth it, you gotta be making money. Your thought process is, no, you're not going to make money on every single thing you do. You're going to, every once in a while, you're going to, you might roll the dice bad and, break even or whatever. But the idea is that you should be positioning yourself to make money. And then once you start making money, then you worry about the asset, how am I going to protect it? I see people who have elaborate asset protection plans with no assets to protect.
Yeah.
It's like,
as Coach Lou would say,
what do you...
Yeah, as Coach Lou would say, this is not a nonprofit organization. We're profit-making. Hey, we got a question in from Mary, which says, if you roll over a 401k into a self-directed 401k, is there an amount limit that you're allowed to roll over? Do you know the answer to that?
There is no limit to what you can roll over. If you have $1 million in a 401k and you want to roll it into a self-directed IRA, there's no limitation that I know of that would prevent you from rolling that entire amount in. There's limits on an annual contribution. So once you roll it into that IRA, you can't contribute, another $50,000 to it. You go, an IRA has a $6,000 a year, $5,500 or $6,000 depending on your age, limit on what you contribute and deduct every year. On an annual basis,
right.
But you can roll over, whatever you want,
Beautiful.
And,
all right, cool.
Yeah, and Kevin's really sharp on that. If you anytime, he's on the directory, and anytime you have questions, he's always happy to talk to people. But it's the other thing that I want to emphasize about this is, again, you want to be maximizing your deductions, okay? And a lot of your deductions, the ones you can take outside of the expenses that you have for actually holding and fixing up the properties, but you will be marketing for properties. If you're a rehabber, you will be marketing for properties. You will be driving. You will be using your cell phone. You will be on the internet. You will be doing this from your home office. All of these things that we talked about with wholesaling are the exact same things, and we want to be making sure that we capture all of this information so that we get what the real net income is. And that way, the lower your net income is, the lower the taxes are, and the more things that you can convert from things you have to pay anyway to deductible business expenses, the better off you're going to be. So that's why
Which goes back to the first slide of keeping good records. Okay, good. So let's move on. So we've handled wholesaling, we've handled rehabbing. What's next?
Okay.
Oh, one more thing. One more question came through. if you are renting a house or an apartment, are you still able to deduct the home office space?
Yes. As long as you have a dedicated office in that rental, then it's the same formula, except instead of deducting a portion of your mortgage payment, you're deducting a portion of your rent payment.
Beautiful.
Okay.
So document it. Take pictures of your space. Show your desktop, show your bulletin board, show your computer and all that stuff, so that you have it on file.
Right. Yep. Exactly. All right. So we'll talk a little bit. About rental. Okay. So
Beautiful.
A lot of people go from being wholesalers and rehabbers, to becoming landlords. Maybe you're making that money, or maybe you just have some money and you want to invest it in rental properties to make a passive income. So rental income, or net rental income, is completely different from wholesaling and rehabbing income from the standpoint that it's not subject to self-employment tax. It's not considered a business. It's considered what the IRS calls a passive activity. Okay, so even though you may be actively managing your property, the IRS considers this a different form of income that's not subject to self-employment tax. It's more like interest and dividends than it is like business income. Okay, the really cool thing about rental properties, okay, is that you can actually have positive cash flow, real money that you can stick in your pocket, and at the same time have a loss for tax purposes in the same year, because of what's called depreciation. And depreciation is the allocation of the purchase price of the rental property over a period of years. So you're literally, in the case of a residential property, the IRS mandates 27 and a half years. So if you buy a rental property for $275,000, you're going to depreciate $10,000 a year for 27 and a half years.
Mm-hmm.
Now, if I've made $10,000 of net positive cash flow on that property, and I literally have that money in my pocket, okay, now I apply the depreciation against that on my books, I've got zero net income, okay? So I don't have to pay any taxes on that income. I've got the $10,000, but I'm not paying a dime in taxes on that $10,000, okay? Now, let's say I have $10,000 of cash flow and $15,000 of depreciation a year. I've got a $5,000 loss. I may or may not be able to deduct that loss depending on my individual situation. And that situation, deductibility of losses, is based on a few key tests. So there's basically three classifications of real estate landlords. There's passive landlords, those people who are going to be unable to deduct losses. They're only going to be able to get to zero, okay, net income, but they never can go below zero. They can't have a $100 loss because they're either not managing their properties or they make over $150,000 a year, okay?
Mm-hmm.
The second category is active investors. These are people who are actively managing their properties. They're collecting the rents. They're calling the plumber when something breaks. They're dealing with all of the issues of the property, and they make less than $150,000 a year. Those people can deduct up to $25,000 of rental losses a year. Okay, that rental loss can be completely made up of depreciation, and you may have net income otherwise, but when you apply the depreciation of the properties against that net income, you end up with a tax loss, which can be applied against your other income, your business income, your W-2 income, that sort of thing. So it allows you to actually reduce the amount of net taxable income you have every year. Okay, but it's different for everybody because it's based on a few key factors. The third category is somebody who's a real estate professional, okay? And a real estate professional is somebody who spends over 750 hours a year managing their properties, and it's more than 50% of what they do in total, okay? So if you manage your properties for 750 hours a year, but you go to work at a job for 2,000 hours a year, you can't be a real estate professional. But if I'm in the real estate business, I could be a realtor, I could be a real estate broker, I could be a developer. Now, all of my activities can be aggregated, and since I spend all my time in the real estate business. It doesn't have to be all in managing my properties. I could be also managing my properties and selling other people's properties. Then I'm considered a real estate professional because all my activities relate to real estate. Okay, and that gives me the unlimited ability to, and we'll talk a little bit more about that, but it gives you the unlimited ability to deduct losses. So here are some. So I've sort of broken these tips down, but we just talked about the buy and hold tip number 1, which is qualify either as an active investor or a real estate professional. If you can qualify as one of these two things, if you're actively managing your properties and make less than $150,000 a year of other income, or you're in the real estate business and you're spending over 750 hours managing your properties, then you are able to deduct losses against your other income, which is very, very important.
Let me just go back to this for just 1 second. So again, this is where records are really, really important. I get a calendar every year, and I write things in there, and I even get calendars and save them. But at one point we were audited, and we had to prove that we had to hit that 750 hour threshold, and so we had to show that we were at our apartments, we were sweeping it up, emptying the garbage, all kinds of things that I'm sure Joanne right now is shuddering because she never does that kind of stuff. But basically, we had to prove to the to the IRS that we were active in our business. So I'd recommend keeping a bit of a diary as you go through, and even if you're driving for dollars, you're driving the neighborhoods, you're looking for properties that you might be interested. Again, this is where keeping track of your mileage is helpful. But you could say from 10 a.m. to 1 p.m. I attended 5 open houses. I went to various meetings to meet other people for my investing career, things like that, so that you're documenting along the way that you are a professional if you want to do that.
Right. Yeah. Exactly. And you definitely want to be keeping those kind of records. And there's like you said, you can have your calendar. There's a lot of different ways you can do it. But yeah, making sure that you document what you're doing. It comes back to good record keeping, and that's why we talk about good record keeping as sort of the foundation of all these strategies. Mm-hmm. So let's go to the next one. Again, even with people with rentals, you want to avoid overpaying your estimated taxes. So my landlords, they're actually coming in and they're saying, this is how much money I made on my rental properties this quarter. Okay, let's factor that in and let's come up with a payment, because again, we don't want to end up at the end of the year, if we are making net cash, if we're making net income that we can't offset with depreciation, because sometimes you've owned the property for so long that you're all depreciated out. You've taken every dollar of depreciation you can. Now you're going to have taxable, rental income unless you go out and buy new properties. If you're in that case, you're going to have to make your estimated payments, and you're going to want to make sure that you're not overpaying them, because we don't want to take cash out of our pocket, give it to the government in basically the form of a interest-free loan, to the government. Let them hold money we could be using to upgrade our properties, buy new properties, make repairs, whatever the deal is. We want to keep our money in our pocket. So we were talking a little bit about depreciation before, and depreciation is that magic that allows us to have cash flow without taxable income. Well, and we talked about a rental property where we bought it for $275,000 and we depreciated it over 27 and a half years. And in that very simplistic kind of calculation of $10,000 a year, what we didn't take into account is that there are, a house or an apartment building or whatever is basically a series of components that and systems that make up, what we consider to be a building. So a building is really, a plumbing system, an electrical system, a heating and cooling system, a building envelope system, the walls and the doors and the windows. And all of these systems have components that can be depreciated over faster than 27 and a half years. The IRS basically has categories, and they say this group of items we consider those 5-year depreciable components, and these group of items we consider those to be 15-year components. Okay, so 5-year components, and let's say we take an apartment building, a list of 5-year components might be things like the appliances, the cabinets in the kitchen, the vanities, the tub, the toilet, the sinks, shelving, ceiling fans, all of those kind of things we have to account for and break out of the cost basis so that we can depreciate them over a shorter period of time. The shorter period of time that we depreciate them, the more deduction we get within those first 5 years, the more cash flow we can shelter with depreciation. Okay. The same thing for the land. There's always a land component to every piece of real estate you buy, unless it's a condominium. But if it's an apartment building, you're going to have a land component. It is sitting on land. So, but there are certain land improvements that are actually depreciable and can be depreciated over 15 years. Things like the parking lot, the landscaping, the sidewalks, the curbs, fencing, all of these things, the value of all of these things need to be broken out of the value of the property so that they can be depreciated faster than 27 and a half years. We're going to depreciate those at over 15 years. So we're just going to divide the cost of those things divided by 15 and calculate our depreciation instead of dividing them by 27 and a half. The idea is that we're depreciating these items faster, okay, and we're using that depreciation to shelter more of the cash flow and potentially create a loss in the case of an active investor or a real estate professional that we can use to offset our other earned income, which is even cooler. So cost segregation is a very, very good tax strategy for creating that additional depreciation. Okay. Now, in some cases, we're going to buy properties that when we buy the property, we know. So we're going to be landlords, but we're going to be rehabbers first. Okay? And when I say rehabbers, what I really mean is we're going to actually go in and fix up the property. But it's our intention to actually hold it as a landlord once it's done. We don't have the intent of just flipping it and selling it after we're done. We're going to hold it. We're going to put tenants in it. Okay? So in this scenario where we're actually going to fix and hold, okay, when we first buy the property, we want to take pictures and itemize all the things that are in the property that are going to end up in a dumpster, essentially. Okay, so let's say I buy a 4-family house, and I've got to gut all the bathrooms and kitchens, okay, because they're awful, I won't be able to rent the units with the kitchens and bathrooms the way they are. Okay, so what do? I go in and I take pictures of all of this stuff, and let's say the property cost me $100,000. Well, I'm going to allocate a portion of that cost to the kitchens and the bathrooms as they existed when I purchased the property. So let's say okay, every kitchen is going to be worth $2,000, and every bathroom is worth $1,000, just as an example. So now I've got 4 kitchens, 4 bathrooms. I've got 4 $2,000 kitchens, $8,000. 4 $1,000 bathrooms, $4,000. I've got $12,000 of original cost basis, what I paid for the property. Okay, that I'm going to break out of that 100, and I'm going to say these things. I'm going to document these things, and I'm going to take pictures of them, and I'm going to allocate costs to them, because when I go to throw them away, I'm going to take an immediate ordinary loss on the abandonment of those assets, the disposal of them, and I'm going to reduce my cost basis on the property, but I'm going to get a tax break right there and then as I've done it, okay? And what's cool about these ordinary losses on abandoned assets is there's no limitation like there's limitations on the rental losses, okay? So if I'm somebody who can't take rental losses or somebody who's already maxed out their $25,000 loss that they can take as an active real estate investor, I can still take the ordinary losses on the items that I've thrown away from the properties, the rental properties that I'm rehabbing. Not the properties I'm going to flip, but the properties I'm actually going to hold and landlord, and I'm only fixing them up to do that. So just as an example, you guys have a CTREA member who bought a pretty large apartment complex, like 200 and something units, knowing that they were going to have to rehab every one of those units, okay? And I think they spent something like $7 million on this property, okay? Well, I think they bought it for $4 million, and they were going to put another $3 million into it, okay? But and we had our engineering firm go out to that property and document everything that was going to be thrown away before they did it. And as a result, they threw away, of the original $4 million of cost basis, they threw away $1.8 million of stuff.
Okay. Wow.
So in the first year, they were able to deduct. Now, this was spread across 10 partners because they brought in a bunch of investors to be able to fund the property. But they were able to get, we got them a $1,800,000 tax deduction in the first year that they were able to allocate to all their partners. Their partners were thrilled. Everybody, even the passive partners, the people who were just putting their money in and would normally be considered passive and wouldn't be able to deduct rental losses, were able to take a portion of this $1.8 million as a loss against their ordinary income. They were ecstatic. It probably saved that group of investors $600,000 or $700,000 on their taxes that year.
Wow.
And that's an extreme example. But if I could show you a way, because you're doing it on a 2-family house, and I can save you $5,000, on your taxes, because I'm going to show you how to throw away $15,000 worth of stuff that you're going to get rid of anyway. And it all comes down to documenting it, to the record keeping that you have to do at the beginning, so you're doing this when you're doing your scope of work, basically,
Okay.
Okay, so my buy and hold tips number 5 and 6 are basically to use your self-directed IRA to buy real estate and to use your self-directed Roth IRA to buy real estate. When you're buying rental properties, if you've got money in your IRA or if you have a Roth IRA, you can use them to buy rental properties. Now, here's the difference. Self-directed IRA, also known as a traditional IRA, is an IRA where when you put money into it, not the rollover, but the contribution, that contribution is tax deductible. But when you take the money out of the IRA, you pay tax on it. So as you get older and you take a portion of the money every year, you pay tax on the portion of that money. In a Roth IRA, the money you put into the Roth isn't deductible, but when you take the money out, it's not taxable. Okay, and there's a way to convert your traditional IRA to a Roth IRA if you're willing to pay the taxes in the year you do the conversion. So here's what one of my clients did. Okay, they took $100,000 that they had in a traditional IRA. Okay, in a year where they didn't have very much regular income, they did a conversion to a Roth. So they paid at the lowest tax rate on the conversions because they had to pay the taxes on the amount. So they converted $100,000, but it was the only income they had that year. Okay, so they literally paid at the lowest possible rate they could have paid taxes on. Now the money is in a Roth. Okay, so they go and they buy a rental property. Okay, and this particular guy is in the business of buying them, fixing them up and holding them for a year or two, and then turning around and selling them, getting them stabilized and selling them, okay? So he goes and using his Roth. Now, he's done this twice already. He's gone in, he put in He started with $100,000. He bought a $100,000 property. He got it stabilized, rented it out for about a year and a half, turned around and sold it for like $175,000. That $75,000 that he made, he'll never pay taxes on that money. Okay. Then he went and he bought. Okay, so because it's in a Roth IRA, he's using Roth money. He's making money inside the Roth, and he won't take it out until he's old. But when he does take it out, it won't be subject to tax. And so he's going to continue to do this. He's only like 45. So then he went and he bought a $175,000 property, give or take, and he did the exact same thing. And a couple of years later, he sold that for like $250,000. Okay, so he made another like $75,000. So now his original 100 that he converted is now like 250. Okay, and he subsequently has bought another property, but that money, he'll never pay tax on that money. That money is tax-free money. All the money that he earns buying, holding, and then selling those rentals at the right time, once he gets them stabilized, the rents increase, fixed up a little bit or whatever, then he's able to make that tax-free money. So using your self-directed, whether it's traditional or Roth, it's a very, very powerful tool for funding your retirement. Something that I highly recommend you using, and something that Kevin Collins, who's another CT REIA vendor that we were talking about before, something he's an expert in, and you should definitely, if you're interested in doing that, should definitely contact him and talk to him about it.
By the way, one more point about this is, I even heard Susie Orman, of all people, who's pretty conservative because she's on public television and all that. She said that traditionally we all think that we're going to be at our lowest tax bracket when we retire. But the truth of the matter is that we'll probably be, one, taxes never go down. They always go up. And number two is, because of our longevity these days and our ability to keep on earning money, it's very likely that your retirement, quote-unquote, retirement income could be as high or higher than what you're currently getting. So having tax-free income is certainly a great way to go. And so she was even saying that, just if you're still working for a regular job, she recommended matching whatever your employer matches on the 401k, and then outside of that, really fund your self-directed IRA or self-directed vehicle as much as possible so that you can make as much into your Roth, self-directed Roth, so that you can never have to pay taxes again after your initial contribution. So I thought that was interesting.
Yeah, no, it is, and the best time to do that is in a year. If you have a year where something else happens that you don't have a lot of income, maybe you take a big loss on a let's say you have a big stock loss that you have to take, or something where your income is down low, maybe.
Or you got laid off, Yeah, if you just got laid off.
Something like that. That's a great time to do those conversions, because that income is going to be taxed at the lowest possible rate that you can get it taxed at. Okay.
Cool.
We'll talk about a couple more things here. Let's talk about repairs. When you're a landlord, it's important to know what qualifies as a repair and what qualifies as an improvement. And there's a whole list of criteria that probably is a little much for what we're doing tonight. But let me just tell you what the difference is. A repair can be deducted in the year that you pay for it. So you spend $1,000 on a repair, you deduct $1,000 on your taxes. An improvement is added to the cost basis of the property and depreciated, okay? And it could be depreciated over 27 and a half years. So you would get, instead of getting a $1,000 deduction, you're going to get a $45 deduction, on $1,000. You're literally going to take, 1/27th of that $1,000 every year for 27 and a half years. So it really makes a big difference. And I'll just give you a couple of the things that, qualify what makes a repair. First of all, the IRS has completely redone all of the repair regulations. So there are specific things now that are absolutely considered repairs. Repaving a driveway is considered a repair, if it exists already. Okay. Replacing mechanicals like hot water heaters and boilers and furnaces and stuff is considered a repair. Okay. replacements to like electrical systems, those all are considered repairs, where in the past those have been improvements, assuming that you're using similar materials when you do that. So you can't replace, so now, for example, painting is considered a repair. But if and floor replacement is considered a repair if I rip out, like if I have industrial carpeting in my apartment, okay, or linoleum floors, and I rip out the linoleum floors and I put new linoleum floors or new, industrial grade carpeting in, that's considered a repair. If I rip out the old linoleum and industrial grade carpeting and I put hardwood floors in the entire apartment, that's considered an improvement because I'm using a superior, more costly material. Okay, so when you're doing these repairs, you want to make sure that you're sort of doing like-kind materials, okay, so that it qualifies as a repair. Also, you always want to try, if you can, to repair. Like a good time to repair is after some kind of an event, So let's say, just as an example, we have a bad storm and you have like a window gets broken. Okay. Well, now that would be a good time to do all your windows.
Yeah, right.
Because now even the non-broken ones, because it happened after an event, I had to replace them all. I couldn't have one blue window and I couldn't have one white window and 42 blue windows. So I had to replace them all. That sort of thing. So, so when you're doing repairs, you want to, before you do repairs, especially if they're big repairs, you want to talk to your accountant about what's the most tax efficient way to do them. Okay. We talked a little bit about this last night. 1031 exchanges. A 1031 exchange is when you sell one rental property and you turn around and you purchase another rental property of equal or greater value. And when you do that, you're able to defer the capital gains tax on the sale of the property. So it's a great strategy for laddering up properties, and for trading out of properties, smaller properties and into larger, more profitable properties as you grow your portfolio. So it's a really nice strategy that a lot of people use. Now, there are a lot of specific rules about that, and just a couple of them are you have to identify a replacement property within 45 days, and you have to close on that replacement property within 180 days. So there's time limits on what you can do. There's a couple of different ways to work it, and it's complicated and technical, but the idea is before you ever sell a property, you want to know what your gain on the sale of that's going to be based on the offer that you got, and then talk to your accountant about what strategies, one of which might be a 1031 exchange, you can use to defer the taxes on that gain. Sometimes if the gain is small enough, or if you can't find a replacement property, you may decide not to. You might just decide to pay the taxes. That's a strategy, okay? Or you might decide to use this 1031 exchange to avoid the taxes and ladder up to a bigger property. So again, it's really specific to what your goals are and what you want to do and how much gain you've got and that sort of thing. So it's really individually driven. So I guess the whole point of all of this is that planning your taxes has become more important than ever because of the nature of the rules, because the rules are relatively complex for a lot of these things, and the record-keeping requirement is now, so what the IRS has basically done is they've given you more loopholes, but they've also made their record-keeping a little more stringent. Okay, so they put the burden on the people that say, hey, if you want to take advantage of these really cool tax strategies, you've got to keep the records in order to make sure you're documenting everything you do. And if you do that, then we're going to give you these breaks. So, but you always want to talk to your CPA about tax strategies whenever you buy a property, sell a property, renovate or repair property, and at year end. So right before year end, I'm talking to all of my clients. How much money are you making this year? Let's do a projection of where you're going to be at year end, because the last thing I want to do with my clients personally is have a conversation on April 14th of why they owe a whole big bunch of money. That conversation we're having that conversation in November and December, and we're doing everything we can before year end to lower it. And then they know they have a period of time to come up with the money. You see where I'm going? It's always better to tell somebody, hey, you're going to owe $20,000 this year. And they say, why? Well, you had a great year. You made $200,000. Oh, cool. Yeah, that's great. I know I had a good year. Yeah, I know. I'm going to owe some taxes. That's cool. Thank you. Now I know that I can set it aside, and I'll have it in April when I need to pay it, as opposed to me telling them 4 days before they got to write the check. So, always talk to your CPA before the year end. And, does it cost a little bit of extra money to have a projection done? Sure. It costs a few $100s, but it's worth it because now it's part of the planning. And if you do it before year end, then there's things you can do before December 31st. There's strategies you can use, to offset it, which are not available after you do that. So, does anybody else have any other questions, I guess?
Yeah, you can type up any questions, or again, you could send an email to membership@CTREA. I'll check this out. But again, so a couple key things, in summary of all this. One is, if you're looking to replace your income because you got laid off, rehabbing and wholesaling is going to be good. But wholesale and rehabbing would be good for replacing a job type of income. But you're also going to be treated by the tax code just like you had a job. So if you are thrilled that you just made $50,000 or $60,000 profit on a rehab, just know that you've got to put money aside to pay those taxes. Now, to offset that, you would agree, right? For a lot of people, it would make sense to buy some rental properties. So maybe you mix it up, and that would, the rental properties can help you offset any kind of income, including income from a rehab or income from a job. Correct?
Right. Yeah, in the right situation, absolutely.
Well, that's a good point. In the right situation, absolutely. So we're not giving any of you tax advice. We can't do that. But and then the other thing that I got out of this is that you may want to check into different entities. Most of us have been hearing a lot about LLCs, but much less about Subchapter S or even C corporations. And so each one of those entities have tax advantages. They also have legal advantages and disadvantages. So you definitely want to sit down with both your attorney and a CPA to figure out which one of those things makes sense. And then, a lot of times here we talk a lot about no money down and owner financing and all those kinds of things. And you may be in a situation where it makes a lot of sense to put a whole lot of money into a property because it, tax-wise and business, it might make sense to.
Hello?
So, whoops. Can you hear me? I think I just disconnected. Okay, you can hear me. Okay, my headset sometimes goes out. So am I right? So some people are in a situation where they have a lot of money set aside, and they may want to use the situations that Ted was just talking about, self-directed IRAs or whatever, but they also may have other situations, just a bunch of cash, and you've got to figure out what to do with it. So you want to sit down with somebody. So hopefully this gave you some highlights. And one last thing, just real quick. If you are a private lender, so if I lend money and I'm getting paid 10%, now if it's in a self-directed IRA, I don't pay taxes on it. But if it's not in a self-directed IRA, how is that interest taxed?
Yeah, it's taxed as passive interest income. So you get it's just like if you had the money in the bank. Now it's a little bit different if you're one of your organized hard money lenders that's all they do. Mm-hmm. Now they're an active trader business, okay, because they're actual mortgage lenders, okay.
Right.
But just the average person who's loaning money out, out of their IRA or out of their personal savings, they're not in the business of being a mortgage broker. They're just investing some of their money. Those people, it's considered passive interest income, and it's taxed at ordinary income rates.
Okay, good. All right,
yeah, but
perfect.
it's not
well,
subject to
okay.
any other taxes, I guess.
Not subject to any other, it's not subject to self-employment tax, for example.
No, right, exactly. Yep.
Okay. All right, cool. Awesome. Ted, this was amazing. Listen, feel free to email me any questions at membership@CTREA. You also have Ted's contact information right here. Also, it's also on our service directory for everybody. And Ted, I really appreciate everything you've done for our coaching students and for our members, over these years. And this was a great presentation. Do you have any final thoughts you want to share with people, or are we good?
No, well, you know what? I think just to reiterate the point that we made before, that it all starts with making money. Go out there and make money, and do deals. And then worry about get something under contract, do some deals, and then we'll put the right tax strategies around what you're doing. Don't get so caught up in the the minutia of getting everything organized. It's always better to go out and start making some money, and then you can always put the infrastructure around you.
And one last thought that I have about this is timing is everything as we're coming to the end of the year, and depending on when you're listening to this, 1031 exchanges done at the end of the year are really hard. The timelines change or something like that. And then also what you were just saying, that if you're rehabbing a house and you start in 1 year and you finish it in the next year, you're not going to get the tax benefit in the first year. You're going to get it in the second year. So there are some timing issues. So again, you may want to talk to your accountant. Don't miss out on a good deal, but there's some creative strategies which we teach, like you might want to buy on a lease option until the next year comes around. That might be tax beneficial. I don't know. I just had that thought. So if that's possible. So just keep those kinds of things in mind, and it's worth sitting down and having a conversation about, look, these are my goals. This is what I'm planning to do. This is what my business model is, and and how to do that. And then also, some of you are really ramping up your business. You're going from 1 deal a year to 10 deals a year and you're going from 1 3-family house to buying a portfolio of 20 to 100 to 400 units. All those different things impact everything. So, but hopefully this gave you some guidelines and some things to think about. So, cool.
Yeah, and one last thing is just that, it is October, and, as we get closer to the end of the year, everybody should be talking to their advisor about where they are during the year so that they can make adjustments before December 31st. So that would be the last thing I would.
Yes, good. All right, everybody, y'all hung in to the very end. This is our longest webinar we've ever done, but I think it was chock full of information. Ted, thanks so much. I really appreciate it. And as soon as your book comes out, we will let everybody on the call know about it, so we can, so that you can hear all about his book that's coming out. So, cool. All right, everybody, have a great night. Thanks for joining us, okay?